don't start selling too soon. That's a mistake, unfortunately, but a lot of the people who've been in gold for a long time, they tend to make. They get out too soon because these cycles are very, very long.
Okay, we talked about base metals like copper.
Yeah.
Oil is considered the main natural resource,
right?
And those resources tend to be very closely associated with the global growth. So, do you have any concerns of a global slowdown in growth or even a crash?
Well, I think it seems we're definitely heading into a slowdown. There's no question about that. And whether it's China, whose GDP growth has gone down to 6% a year, which is pretty good by most people's standards, or Germany, which actually had negative growth one period last year. I believe that's right. But I mean, it's under 1% anyway. Yeah. And then in the US, you look at underlying issues and you see there are some real problems in the economy. So yes, I think the global economy is heading into a slowing phase. I don't think it's necessarily going to be a crash, and I do think there are also things that could happen, like a trade deal between China and the US that would really help to revitalize the global economy pretty quickly. But the basic factor is there's too much debt in the world. That's the basic factor.
Okay.
Less in Germany, good on you, but most countries in the world just plain have too much debt, whether it's Japan or China or US, and you know, that's why we have these negative interest rates, and you know, that's a situation that simply cannot lead to solid, it can't lead to savings. Yeah. And it can't lead, if you don't have savings, you don't have capital investment.
Would you say it's talking about that, that is, it is a problem worldwide that countries and companies are very much dependent nowadays on very low interest rates to service the debt?
I think that is a problem.
Okay.
As you know, I mean, the amount of debt since 2008, both public debt and private debt, has gone up tremendously. We have more debt today than we did it in 2008 in the credit crisis. And one of the reasons for that explosion is because people can borrow money so easily. So you get good companies who now have taken on too much debt. You also have zombie companies that frankly shouldn't be alive, you know, and
zombie governments.
And zombie governments too, yeah. But I mean, you don't have to think of Darwinian survival of the fittest, but capitalism is replenishment of old and failing companies with new and growing companies. Creative destruction, as Schumpeter called it. And the problem with low interest rates is you don't get the destruction part of it. Companies can stay alive much longer than they should.
And talking about the Fed and the central banks, where do you think this is leading? And maybe you could point out what this means for commodities investors.
Yeah. We're obviously in uncharted territory, literally. You know, people throw that around a lot, but we are literally in uncharted territories. Never in the history of the world have we had rates this low, and never before have we had negative interest rates. I think the central banks have basically boxed themselves into a corner, and last year the Fed, the European Central Bank, and even the Bank of Japan said they were ending their easy money policies and we're going to start tightening. Well, how long has that lasted? You know, that lasted a few months before they all decided, ECB as well as the Fed, decided to reverse and start easing again.
And this is unsustainable in the long run.
This is unsustainable. Where does it lead? You know, without being apocalyptic about it, easy money basically means the destruction of purchasing power, right? And it means the destruction of savings. So we know from history that when people save money and then those savings are destroyed, we know that it leads to social problems. And depending on how dramatic that erasure, that destruction of purchasing power is, really depends on how dramatic the results are. But it's interesting, Ray Dalio, you know, who is a famous hedge fund manager and recently turned very bullish on gold, he published a paper recently on modern monetary theory. Have you heard of modern monetary theory in Germany?
I did. I actually read part of the book. So,
I mean, modern monetary theory basically means that as long as a government lends to it in its own currency, it can print as much money as it wants, and we can all have and buy all the things that we all want. In this paper, he said that it was very benign. He kind of said that MMT, modern monetary theory, was inevitable. The way we're going with negative interest rates is inevitable.
Yeah.
And he said we shouldn't be too worried about it, or he implied, I should say, we shouldn't be too concerned about it because it has been implemented many times before in history.
And failed.
And he mentioned several, no, but it gets worse. He mentioned several examples before in history where modern monetary theory had been, or a variation of modern monetary theory had been introduced. He mentioned Dionysius in the Roman Empire. He mentioned the Jin dynasty in 13th century China. He mentioned the early Stuart kings in England. He mentioned, forgive me, he mentioned the big inflation in the 1920s in Germany. What was the end result of all of those examples?
Hyperinflation.
It was hyperinflation, but it was war. More importantly, it was war. So the net result of destroying money is tyranny and war. And we've seen that over and over in history. So, you know, when we stand here today, that seems like kind of crazy to talk about that. In 1910,
nobody thought
it sounded pretty crazy, both in Germany and in England, to think about war. And I think that's true in many of those periods of history.
Yeah, let's hope we are not heading into that direction, but certainly we are, with all that easing of the central banks into even if it's not common knowledge yet, so maybe inflation could rise and this could be bullish for gold.
I think so, because here's the point, if I may. To have inflation, inflation is always and everywhere a monetary phenomenon. That's what Milton Friedman said, and I think it was correct. To have inflation, however, you have to have three things. You have to have money created by the government, so the central bank has to create money. The banks have to borrow that money, but the banks also have to lend it, right? So what we had after 2008 in the US, at any rate, was we had the Federal Reserve's balance sheet go up quintupled, go up fivefold. So we suddenly had the money created. The banks borrowed that money, but because of the Fed's idiotic policy of paying interest on excess reserves, the banks simply lent the money back to the Fed and put it on deposit with the Fed. Was that the Fed's intention? I don't know. But the net result was you had the huge increase in money supply. Banks borrowed the money at 0.25% or 1/8%, put it back on deposit with the Fed, or 0.75%. What's not, as they say, what's not to like? I mean, banks, the money center banks in the US could borrow as much money as they wanted, put it back on deposit, and make a risk-free return. Why would they bother lending that money into the real economy? And so you didn't have that third component, which is why we didn't have inflation from 2008, despite the increase in the money supply. But if you get to a point where the banks start lending that money again, then that money gets into the real economy and leads to, I think, significant and dramatic inflation. Because all the money that's been created is still there. You know, it's still there. Once it gets into the real economy, it leads to inflation.
Being a natural resources specialist and a money manager, how do you manage your money and the money for you're entrusted with? Currently, what could investors listening to this interview learn currently?
Well, one thing is we certainly have most of our money in gold, because I think gold at the current moment, with both the potential but also with the risks in the global economy, gold is the best risk-reward asset to hold. So you could have the scenario B, which we don't want, but gold would do well in that scenario where other metals would not necessarily in the initial phase. So anyway,
physical gold or
well, physical, but we own physical and ETFs, and then the really solid companies like the big royalty companies, which I don't think have anywhere near as much risk as the mining companies. But I think the biggest takeaway, frankly, is that mining is a very cyclical business. We know that. We've been through the cycles before. We are at a low point in the cycle. And what I would say to people is, if you've been in this sector for a long time, a long-suffering participant, you've seen your assets go down 50, 40, 50, 60, 70%. Now we've had a little bit of a run. Don't start selling too soon. That's a mistake. Unfortunately, but a lot of the people who've been in gold for a long time, they tend to make. They get out too soon because these cycles are very, very long. And if you look at gold stocks, for example, the prices today are certainly well under the 20-year median prices. But more importantly, the valuations are also well under the median 20-year averages. So you've got prices and valuations below your long-term average, which means you have tremendous leverage as the earnings start to come in and the prices and the valuations start recovering.
So we obviously are contrarians, but this is where money is made, and so you say it's a big opportunity right now.
I think you have to be a contrarian. In the resource sector, you have to be contrarian.